Welcome, everybody. My name is Monty Kane, and I am going to be leading our webcast today on COVID-19 and the CARES Act. That's going to cover businesses in general, and also we're going to be discussing the implications of COVID-19 and perhaps part of the CARES Act to community associations. So we want to welcome you today. I'm a principal with Morrison Brown Ortiz and Farah. We go with the MBAF. And by the way, some people are chatting that they don't see me because you're not going to see myself or the presenters today, but that does bring up the question in terms of how you communicate with us. We do, at the bottom of your screen, there's a question and answer tab. So please take a look at that. And at any time you can submit your questions and then later on in the presentation, we will try to get to as many as possible. So that being said, let me just discuss, mention to you that I'm joined by my two partners, Carl Gudinski, who is a tax partner with our firm and also is very well versed in both the the CARES Act and community associations. And my partner, Jeff Ducker, who's a partner in the Audit and Assurance Services Department and also has led our group over many, many years. Actually, I will tell you that our firm experience in the condominium association goes back over 40 years, and our firm, MBAF, just celebrated our 50th anniversary. So that being said, I want to show you what our agenda is today. So we will be going over the CARES Act, and the CARES stands for Coronavirus Aid, Relief, and Economic Stimulus Act. After that, we're going to be going over how this act applies to condominiums, cooperatives, and home associations. That part of discussion, these two parts, will be covered by Carl Gudinski, and thereafter, Jeff Ducker is going to pick up the discussion in terms of what associations should be doing now in light of COVID-19. Lots of things going on. I know it's a tough time for everybody. Now, most of us are working from home. Our entire office has been working from home for now 5 weeks, and we want everyone to stay safe, of course. And as it relates to businesses, as it relates to condominiums or whatever, we're here to serve you. So that being said, I turn it over to Carl Gudinski. Carl?
Thank you, Monty, and good afternoon, everyone. Well, you know, the April 15th deadline came and went pretty quietly this year. This is because, as many of you may be aware, the government automatically extended tax returns and payments that were due on April 15th to July 15th, so automatic 90-day extension. This extension included individual returns, certain corporate returns, trust returns, and many other informational returns that were due between April 15th and July 15th. For those of you who make quarterly estimated payments, the first 2 quarters of 2020 were also part of this extension, so those payments were extended also until July 15th. Now, if you still need more time, come July 15th to file, no problem. You can request an extension at that time. But keep in mind, you still need to make your payments to avoid any interest and penalties. Okay, the stimulus, and now on to the CARES Act. So the stimulus payments, which I'm sure most of you heard about, and the government has already started sending these out. And these stimulus payments are based upon your last filed tax return. So for many of you, it's going to be either the 18 return or the 19 return if you've already filed those. So how much can you get? How much can you receive? So you can receive for a single filer $1,200 and $2,400 for a joint filer. And added to that is $500 for each dependent child under 17 years of age. But unfortunately, not everyone will be receiving these stimulus payments. There are phase outs. So for a single filer who makes over $75,000, that payment will be reduced, and will be totally phased out at $99,000. So if you make more than that, looks like you will not be getting a stimulus payment. For joint filers, it starts phasing out at $150,000 and totally phased out at $198,000. Now, even though the government is sending the payments now, it is really a 2020 stimulus payment. So in other words, if your income was above those thresholds based upon your 2018 or 2019 returns, and you did not get a stimulus payment or it was reduced, if your income now in 2020 drops below those thresholds, you made less income in 2020, which is probably going to happen to a lot of people, you may be entitled to a stimulus payment at that time when you file your 2020 return next year. So if you don't qualify now, you may qualify next year. Okay, on the retirement plan, some good benefits here. Generally, if you take a retirement distribution from your IRA or your 401k before the age of 59 and a half, you're going to incur what they call the 10% early distribution penalty. Under the CARES Act, though, that 10% penalty is waived for a coronavirus-related distribution up to $100,000. So what is a coronavirus-related distribution? So that is a distribution made to someone who is diagnosed with the virus, whose spouse or dependent has been diagnosed with this virus, or who experiences adverse financial consequences as a result of being either furloughed or quarantined. Another benefit is that the individual can spread the distribution over a 3-year period. So you only have to recognize 1/3 of that income on your tax return in 2020, another 1/3 in 2021, and the final in 2022. And also, you can actually return that distribution. You have 3 years from the date you receive it to return distribution, and you would not have to report any of that income or any income on that distribution. Okay, continuing with the retirement plan changes. For those of you who are required to take a minimum distribution, for those individuals over 70 and a half years of age, you can actually suspend that distribution for 2020. You do not need to take that distribution in 2020. And the reason for this is that the government does not want to penalize you for taking a 2020 distribution, which is going to be based upon the value of your account at December 2019, when the value was probably of your retirement account was probably higher than it is now. So in other words, you're given the opportunity to have your retirement account recover from this crash. Okay, charitable contributions. So this is new under the CARES Act. For those of you who itemize, for those of you who don't itemize, you can now take advantage of up to $300 deduction for any contributions you make to your favorite charities. This is going to be in addition to your standard deduction. So you'll get your standard deduction plus another $300 up to $300 for a donation. Now, if you do itemize, you were in the past you were limited to how much you can deduct, which was basically 60% of your income for charitable donations. That was waived. So in 2020, if you itemize, you can deduct all of your charitable contributions. They would not be phased out. Okay. One more slide. I think we're on the next slide.
There's a little technology issue here. Well, here we go.
Okay. Okay. Yes, also new under the CARES Act. So before the CARES Act, an employer could pay up to $5,250 for an employee's education, and that payment would not be subject to tax by the employee. Now for 2020 only, under the CARES Act, the employer can actually pay down an employee's student loan debt and interest up to $5,250 tax-free to the employee. And the employer can do a combination of either education and student loan debt, but it cannot exceed the $5,250. And unfortunately, though, the employee would not be able to deduct any student interest that the employer paid on their behalf. Okay, now I'm going to just switch over to the business side of the CARES Act. There's a new employee retention credit. This was enacted to encourage employers to retain their employees and their salary levels for the remainder of the year. This is a credit against the payroll taxes. The credit is equal to 50% of wages up to $10,000 per employee. Now, you don't get the credit if you receive the payroll protection loan, which I'll discuss shortly. The credit is applied to an employer who satisfies either one of the two tests. The first test, I think we're on the next slide, Monty. Okay, anyway, the first test is the furlough test. And for that test, you must have a partial or full suspension of your business due to order from the government. The other test that you can meet is the drop in receipts test, and that's when your gross receipts for the quarter is less than 50% of the gross receipts for the same quarter in the prior year. And this credit is going to, you're going to lose this credit once you reach at least 80% of your gross receipts from the prior year. The credit applies to, like I said, businesses, including certain tax-exempt organizations. Now, this credit is refundable, so there's an opportunity for the employer to receive money back. Okay. Another benefit for the employers is they actually can defer their portion of the Social Security taxes that they are normally due. And these can be deferred. Half of those employer Social Security payments can be paid in 2021, and the other half can be paid in 2022. And again, if you have a payroll protection loan and it was forgiven, this credit would not apply, and I'll go into that shortly. Okay, changes to the net operating loss rules. So for those of you who remember, back in 2017, we had a big tax act, and that tax act eliminated the ability to carry back what they call carry back a net operating loss. So basically, if your business when your business losses or expenses exceed your business income, you're going to have this net operating loss. Now, new under the CARES Act, the government brought back the ability to, when you do have this net operating loss, to carry it back to a prior year. So why would you want to do that? You would want to do that to apply this loss to a prior year, reduce your income in that prior year, and get a refund. Also, this change to the net operating loss rules is retroactive back to 2018. So if you had a net operating loss in that year that you couldn't take under the old rule, now you can take it and you can carry that loss back up to 5 years. So that can go all the way back to 2013. And if you had income in 13, 14 going forward, you can apply these losses against that your income and again receive refunds. Okay. Also, qualified improvement property. Under the Tax Act in 2017 that I just mentioned, there was an oversight by the government where it failed to give this type of property a 15-year life, which would entitle it to a 100% deduction in year one when you incur these costs. So you would get an immediate write-off on these qualified improvement costs. So what are these costs? These are qualified improvement property costs are basically expenses incurred to the interior portion of a commercial building. And this includes the plumbing work, electrical work, drywall work. Normally, these expenses would have to be depreciated over a long period of time. But under these rules, if it's given a 15-year life, it could be expensed immediately. Now, the CARES Act fixed this correction and gave this property a 15-year life, which now would entitle you to a write-off in year one. And this rule is also retroactive back to 18. So if you had these costs in 18 that you couldn't expense, or 19 that you couldn't expense, you can now go back and amend those returns to create these larger deductions. And if these deductions, like I mentioned previously, created a net operating loss, you can carry these losses back and recoup some taxes. So that could be a big help. Program, which a lot of people I'm sure have heard of and have already applied for. I know the funds are running low now, and there's talk about getting some more funds, the government providing some more funds into this program. But what makes it so popular is that it has a provision where they would forgive all or a portion of the loan, whatever you receive, tax-free. So that's really what is making it so popular. So who's eligible for this type of loan? It's generally going to be your businesses, and that includes sole proprietorships, independent contractors, certain not-for-profit organizations. Since it is a SBA loan, it's generally going to be limited to employers that have less than 500 employees. So an important question is, how much can I get? So you're entitled to the average of your prior year monthly payroll costs, which I'll discuss next, times a 2.5 multiplier, or $10 million, whichever is less. So how much can you receive? So the payroll cost is going to include salaries, your W-2 salaries. It's going to include other payroll benefits such as health insurance that the employer pays on your behalf, your vacation pay, sick pay, state or local taxes assessed on compensation, which you don't have that here in Florida. For sole proprietors and independent contractors, the payroll costs are going to basically be your net earnings. And these costs are going to be capped at $100,000 per employee. So as I mentioned before, a portion or possibly all of the loan that you receive may be forgiven tax-free if the loan proceeds are spent on certain types of costs during an 8-week period beginning on the date of the loan. So what do you have to spend it on to get this forgiveness? The costs are going to be the payroll costs, which I just mentioned. There's going to mortgage interest if your business has a mortgage, rent that's under a lease agreement enforced before February 15th, and certain utility payments, again, that for which service began by or before February 15th. One thing that I don't think is on the slide here is that it's my understanding that only 25% 5% of the non-payroll costs that I just mentioned will count toward the loan forgiveness. So keep that in mind. Now, the loan, there are some requirements. The loan will not be forgiven if you do not maintain your workforce or you reduce salaries by more than 25%. So they want you to keep your salary levels and your employees in place. Now you can avoid the reduction if you restore your employment levels and salary levels by June 30th. Okay. There are other loans out there under the CARES Act, or there's an Economic Injury Disaster Loan, or EIDL. Now, disaster loans have always been in place, but the CARES Act made some certain modifications, such as you'll see there, no personal guarantee for loans up to $2,000. It opened it up to more businesses, including sole proprietors, independent contractors, certain not-for-profits, and no longer required to be in business for a year to qualify. Another important feature of these disaster loans is that you may be entitled to an advance or a grant of $10,000 paid immediately within 3 days of the application, which does not need to be paid back even if your loan is not approved.
So, Carl, so you've gone over the CARES Act, and questions have been coming in, which we'll take a little bit later. But at this point, what is it in the CARES Act that specifically applies to condominiums, cooperative housing corporations, homeowner associations, and what should they be looking for in terms of relief under the CARES Act?
Well, you know, to the associations, the homeowners, the condo associations, you know, I think that they're really going to be limited here on what they may be able to take advantage of as far as the tax implications. I mean, I mentioned the NOL, the NOL, net operating losses that can now be carried back. I know associations may generate these type of losses, and if they had to come in prior years, they could carry it back to. Great, they can do that. There's a lot of benefits mentioned for employers under these different types of payroll credits or payroll deferrals. I know associations generally don't maintain their own employees, so that may be, I don't know how many of the associations will be able to take advantage of that. The loans, I know the popular payroll protection loan is, the research we've done and what we've heard is that those currently are not available to associations or condominium associations. It's basically limited to 501c3 type not-for-profits, which are going to be your churches, your hospitals, your schools. It seems to be kind of limited right now to those types of organizations. But the disaster loans, again, from what we've seen, I think there could be possibly relief for the associations on getting these disaster loans. I don't know what the terms would be, but I would probably advise them to, if it looks like they may need some help there, to contact their banker and see what would be available to them.
So on the Paycheck Protection Program, although we don't see that condos, homeowner associations, and cooperative housing qualified, there seems to be some rumblings going on by people involved in the industry, and many of them are looking for a Community Association Institute, CAI, which is the umbrella organization for that industry, to approach Congress, and people are writing in for relief. So we're going to just say stay tuned on that one. because there will be a lot of pressure imposed, but I don't know whether or not CAI and the condominium and homeowner association industry has enough political say-so. You just never know. So we'll just say stay tuned on that. But on the issue of the disaster loans, Carl, we're not looking for physical disaster loans that would be available if there was a hurricane or tornadoes or such. We're looking at economic injury disaster loans. And I guess the question there is going to be, what type of economic injury does the association incur? And we'll wait till we get to Jeff's section to address that again. I do see questions coming in. I want those of you who've been sending the questions coming in that we will address as many as we can. And we're going to now move it over to a section that Jeff Ducker will be going over as to what condos, co-ops, and homeowner associations should be doing now in light of the COVID-19 and what its effect has been on the economy now and going forward. So Jeff, you're on.
Thank you, Monty. Good afternoon, everyone, and thank you for being here. So as to the association's financial health, as you know, the balance sheet reflects the financial condition of your association. And it's very possible that over a period of time, the financial health might take a little bit of a hit. And if you don't know why, I'm going to tell you. And basically, your balance sheet has cash. The main items on the balance sheet are cash, receivables, and payables. Cash is always king, and you want to have as much cash as you can. Receivables are the area that I was referring to, which could conceivably take a hit. Now, I've been speaking to some of my clients who have told me that their collections have been very stable so far, but some of them who are pretty astute say, you know, we're not sure that that's going to continue. So to the extent that that receivables collections start to fall behind, you know, it requires you to take additional measures in your collection efforts. You may see situations where, and I'm aware of one situation where an owner came to the property manager and asked him to, if the board would consider reducing maintenance assessments. And that's a whole different story, folks, that we can talk about when we talk about amended budgets, but it's not something that this board took very kindly to and basically told this particular gentleman that that was not going to happen. So the other thing on your balance sheet that you should always be looking at, and more so right now, and by the way, everything that I'm saying right now regarding financial health is of more significance because of the fact that this is an unknown. This is way different than some of the downturns we've had in the past, where the government was able to bail out certain industries. This is a situation caused by the human element, and we have no idea how long it's going to last. So there's a lot of unknowns in this situation. But you want to do your best to maintain your working capital if you assess on a monthly basis at 2 months of maintenance assessments. And if you assess on a quarterly basis, we're going to suggest 1 quarter of maintenance assessments.
Jeff, when you say working capital, what are we talking about?
Working capital is the difference between assets and liabilities. On your particular financial statements, community associations, it should be referred to as fund balance. Generally, in a commercial business, it's retained earnings. Okay. So it is, with respect to the profit and loss statement, revenues and expenses, remember that your revenues, regardless of your collections, are always going to show what your budgeted amount is. And your expenses are your expenses. So don't be deceived in the fact, and I'm sure you're all familiar with how to read the statements, don't be deceived by the fact that your revenues are staying constant. What's key is the collections of those revenues. And I'm going to jump into forecasts and projections as it relates to some of these items as it relates to expenses. So the factors to consider, we've already talked about delinquencies. I think that that's the most important issue that associations need to contend with right now. You know, I think there are also going to be requests to waive late fees. I don't think that's a bad idea, because people, that might be one concession that you make. Lowering assessments is a totally different story. I am also aware that associations have shut down amenities, maybe not all amenities, but there have been emergency board meetings that were held in March where the subject matter of that particular meeting was, we're closing all our amenities. That's going to give you an opportunity to curtail some services. And I would look at all the services that your providers are performing and see where you can possibly conserve. You may put in some utility conservation measures. You might look at irrigation. You might look at landscaping. We mentioned amenities. You certainly might look at valet and security, depending on your level and depending on how the association feels about that. That's another area that you could consider. But, you have to be concerned about the future. Consider the worst, plan for the worst, and put your association in the best financial position that you can. And by the way, that means that boards of directors that meet typically once a month, sometimes less, need to be, even though they may not be able to meet in person, need to be conferring on a very regular basis and really being on top of what's going on in the association, because ultimately the membership, the constituency is going to look to the board to make the important decisions for the association. Let's move to sources of funds. Many associations have already established lines of credit, most often for emergencies, and certainly this qualifies as an emergency. There's a website, notwithstanding the payroll protection plan problems that we've discussed briefly. There's a website, I believe it is sba.org/payroll protection. Those are all of the banks, that lists all the banks that are participating in that program. You probably have a good relationship with your own banker, and depending on the condition of your delinquencies, and I would say better now than later, because your delinquencies could take a negative turn. Try to obtain a line of credit as soon as you can, because as you know, banks look at your receivables, and the older your receivables and the more that's in delinquencies, the less likely you would be to be approved. So take a look at that as quickly as possible. The other thing you might consider, if you think it's necessary, and the board is able to do this, and sometimes the members might need to be involved depending on the extent of the special assessment, is to adopt a special assessment specifically for this purpose. And that's just all I have to say about that. It's an avenue of obtaining additional funds, and the subject of amended budgets has come up. This is something I would defer to your legal counsel. To the best of my knowledge, the statutes provide for your ability to do that. If in fact you're considering lowering the reserve assessments, because that might be one way to give some relief to the members, that would require a membership vote. So again, if you want to do something like that, I suggest strongly checking with legal counsel. So in the action steps, we've already talked about implementation, but I'm going to say monitoring. The monitoring of your financials on at least a monthly basis, if not more frequently, if your accounting system allows for that, is so important at this point in time. I can't overemphasize it. That concludes my presentation.
Well, you thought that concluded it, but we have some more here. So we got questions here, but after hearing your presentation, you had made a comment about that we presume that everyone on this call knows how to read the financial statements. So the question is, from our experience and what we've seen, do all board members know how to read those financial statements?
Yes and no. Some are better than others, and generally the treasurer is the most proficient, but it varies by association. I have a client in another part of the state where the new treasurer is a healthcare guy, but the past treasurer, who's now the vice president, is a CPA. So they have a person on their board that certainly can read financials. And I would suggest that if there are questions, if you're not self-managed, if you have a management company, they're your first call. you want to speak to them and make sure that they can help you with that. If you feel more comfortable contacting your independent CPA, that's certainly another avenue. But, and particularly since I just mentioned that boards need to be more proactive, they need to understand the statements better than they probably ever did. And by the way, I'm sorry, Monty, I failed to mention, and many of you may already know this, but the Department of Business and Professional Regulation issued Executive Order 2020-04, which states that the timing requirement for condominium associations, cooperatives, and timeshares financial reports pursuant to the particular section of the Act have been suspended and tolled. That means that the April 30th deadline that's been stated in the statutes has been suspended, and they haven't even stated, like the IRS has, you got 3 months more. They just told it and suspended it. So that date is no longer need to be heeded.
And so for those of you calling from our New York office, I do see some people calling from our New York office, and maybe perhaps some of our clients in the New York area. That doesn't pertain to you. This is just for our Florida clients. We practice and we have clients in all states, but our office isn't about just 5 of them. So, but we can handle anything from anywhere. Good point. But as to reading financial statements, it really, I guess the question, Jeff, on this is, do all board members have a responsibility to understand the financial statements?
That's a loud and clear yes, Monty. That's a loud and clear yes.
For those who are not skilled, is there a way to dumb it down?
That's a good question, to dumb it down. From the standpoint of what I'm presenting, or in terms of their reading of financial?
No, from standpoint, yeah, for both. You're reading financial and
okay. Well, yeah, I would say this. If we talk about the balance sheet, which is, as I said, your statement of financial condition at a particular point in time, at a snapshot in time. Let's say you're looking at your February 29th, 2020 financial statement. That's going to show you what your cash balance is, what your receivable balance is, what your accounts payable balance is, what your, and in essence, your working capital, your fund balance. There are other items on your balance sheet, but they're less significant, generally speaking. You have things like prepaid insurance, you have prepaid maintenance, et cetera. But the most important thing you need to look at are the 3 main categories that I mentioned: cash, receivables, and payables. If your cash and receivables are solid and you're collecting your receivables and you're properly doing your accounting and accruing all your expenses and your payables are accurate, you have a pretty good handle on where you stand.
Well, I think that was an excellent answer, because to those board members who know the financial aspects of it, your explanation is something that should be parroted to the other board members, just the basics there, because how many times have we been to board meetings, and I've served on boards before, where some of the board members are only there for one agenda, and the financial part, they just allow the treasurer to handle, or the most experienced person, and they just kind of not pay attention to it. So given this situation, we take the position, Jeff, I, Carl, and our other 30 some odd people take the position that every board member has a stake in this, because if something is not done right, the entire board will be looked at. So this is a matter of working very closely with all the board members. So I think that was good. Jeff, the next part of our presentation, if I can get these slides to move, are the questions. So I've got questions from people that have chimed in today, and it looks as if the attendees actually have picked up since the beginning quite a bit. And I also have some questions that were raised before, sent in to us before. So I'm just going to bounce around and send it to you. So the first question I think is going to be for Carl. Carl, one of the questions that came in from Alejandro, and I think we know Alejandro, he said, the news today is that the small business and the government has run out of money. So what happens next, Paul?
Well, I guess you'll have to, what I saying that if you've applied and received I think, Jeff, you mentioned this to me, if you applied and received a loan number, then it looks like you're safe. But other than that, if I know they were low. I know they said there was only there wasn't much left in the funding. There's talk, the president is trying to get some more funding. But yeah, I mean, apply if you think you're going to need this loan or you qualify, and I would apply right away. But if they've run out, I guess you're late.
So I'm getting these calls also from our commercial clients from all different industries saying that they haven't applied yet. They're putting all the information together. And what happens if their bank it says, no, we stopped? And so, what we've been hearing in South Florida, and I can't talk for the banks in Central Florida, but we're going to check with them as well, and in other areas that you may be located, that some of the big banks will dry up, but a lot of the community banks may not. And a lot of the community banks have actually reached out to us, being such a large CPA firm, to say, send those people over to us, even if they haven't had a relationship with us, because we think we're going to have the funds, and we'll just ask for them to bring their accounts over, which is of course fair. So that's just something to consider. And as to more funds coming, I suspect that we're going to see eventually, maybe this week, hopefully, our Congress come and agree to the second stage of the stimulus.
So there's also, as I mentioned before, there's also the disaster loans that I'm not sure what their status is. The payroll protection was very popular because of the loan forgiveness, and that's why it went quick. But, the disaster loans are also a good option.
Okay. Jeff, I know you mentioned it briefly, but one of the questions that came in is, how can we get to use our reserve funds when we don't have any other source of funds to rely on?
So the answer to that is if you need to use reserves for other than their intended purposes, and the intended purposes are your common area components that are covered in your reserve study. If you need to use it for operating and there's sufficient funds there, that requires a vote of the membership. Other than that, it is illegal, pursuant to Florida statutes, to use reserve funds for other than reserve items. The unit owner vote is the only way you can do that.
And so I just want to mention to you that we have some very esteemed lawyers listening in. I can look at the list here, and you know who you are, lawyers. And so we as CPAs do not give out legal advice. We're giving out advice based on what we've seen over the years, but certainly you should check with your association's attorneys. As a matter of fact, that brings up the concept of, what reliance should associations and businesses place on their CPAs and their attorneys at this time? Who wants to take that question? You, Jeff, or Carl? Jeff,
I can take that one, Monty.
Okay.
So a question has come up in terms of, future, if you're going to amend your budget, if that's something that your attorney recommends and it's something you really need to do, you may want to reach out to your CPA, who can certainly not participate in determining the budget and amounts for different line items, but certainly can participate in a virtual session, as a facilitator, or you can bounce questions off of the CPA based on their knowledge and history with the association and with these concepts. So they would serve in a consulting capacity to you, and certainly legal counsel from any of the legal factors that come into play would be there, and you might want to have a session that includes both of them because they work closely together in many cases in any event.
And to further your point, I can't speak for associations, but generally in businesses that suffer losses, many of them may have business interruption insurance available to them within their commercial policies. Now, it's possible that pandemics are excluded, but maybe not. So over the years, when businesses have had interruptions from hurricanes, fires, floods, and the like, we have actually calculated, both for our clients and also insurance companies have hired us through their counsel to calculate the business interruption claims. This is a situation where in a business interruption claim today, where your expenses are covered while you're operating there, and where you may also get your normal profit there. This is a situation today where business interruption policies, in my opinion, can take forever to be resolved. Whereas in other cases, usually the interruption period may be 30 days, 60 days, 90 days, or longer, depending on how long it takes to get the business back up and running. But what we have today is something very unique, something that none of us probably who are on this call have ever had experience. So just watch out for the business interruption insurance. And if in fact the attorneys who specialize in the industry can see that that's in any of the association policies, please contact us after the fact, because that would be a great relief. I have another, I'm just going to try to summarize this question, Jeff, and that is, someone has said that their association has been suffering delinquencies for years because they keep having special projects, and they go over those projects. When I say they go over, their expenses exceeded the assessments. And we know that in South Florida, in Southeast Florida, along the coast, we have a lot of older, and even on the Southwest coast where we serve too, we have a lot of older buildings that are going through a lot of rehab, recertification, and a lot of structural works being done. Usually these things come in, the actual expenses come in over, more so that often not expenses exceed the amounts they've assessed, and they have to have another assessment. Sometimes these assessments have long-term payouts. They could be 5, 10, 15 years. So owners are struggling with the regular maintenance assessments and then these add-on assessments. So if you have a deficit, no working capital, it's running on bank loans, and now you're faced with this, what do you do, Jeff?
Well, there are not a lot of alternatives. I would be hopeful that an association in this case has has reserve funds available, and maybe certain portions of what was special assessed for and a special assessment funds were used for, conceivably could be not borrowed but moved over from the reserve fund, because perhaps the purpose of the special assessment, the large project, entailed reserve items. So if in fact there are reserve funds, I would look to see, first of all, if you could possibly move them over, but certainly check with legal counsel first. If you wanted to take reserve funds, as I said earlier, the statute is clear on a membership vote being used for that purpose. If you're not in a position where your reserves are covered, I think you need to just go back to the membership. And the lines of credit, there's really not much else available. An amended budget with higher maintenance assessments is going to be very difficult to sell at this point in time. So, we've seen situations where special assessments have been adopted because the first special assessment didn't cover what ultimately wound up being the cost of the project.
So, as to that point, those that have all of these loans outstanding, they don't have a positive working capital. Now they're faced with this. That's a concern in terms of, was the board trying to squeeze by with all these special assessments and try to keep the assessment level as low as possible? And now when this unexpected event occurs, it really it hurts really badly.
You know, and by the way, my response about reserves, as I think back on it, while theoretically it's valid, most associations that have put themselves in this position probably have waived reserves along the way, or have underfunded reserves. And I have an experience with an association in Broward County that we handled over 20 years ago, which never funded reserves, and they came up with a $15 million special assessment because of the fact that they hadn't put aside any money. So Monty's right. You know, you can't undo the errors of the past. You can only move forward and take whatever remedial measures you have available, which may be limited, unfortunately.
And Jeff, you know, the issue here is that many people are unemployed, or they've seen tremendous reduction in their savings and investments that they were counting on to cover their expenses. Is there a methodology for hardships the board can consider on a case-by-case basis? Are you aware of that?
I am not personally aware of that, Monty. I can't answer that.
Okay, well, so you know, that's something else for every association to talk to their attorneys about now. I would not, and I'm not trying to push attorneys here, but I'm telling you, this is not the time to worry about your attorney bills. I know the attorneys are going to be fair and reasonable, because that's what we all do all the time. We understand how everyone is hurting, but in the past, when we've seen mainly from hurricanes and their calamities, we've seen where owners have had a difficult time coming up with the assessments, and there were committees set up to deal with it on a case-by-case basis. There was something that used to be called selective enforcement, where you couldn't make deals for people that weren't available to everybody else. But I'm not an attorney, so I would be prepared I would go to the attorneys now, be prepared, talk to them about it. Hopefully you don't even have to use that, but somebody's going to ask, and it may be a really good friend or somebody that people respect and need help. So we know today that people are sitting in their apartments, can't get out of their apartments, some are elderly, and we see now such an outpouring of help here. I say at this time of our country, we need to, you know, really display a lot of kindness, and there's a lot of kindness going on. There are many other questions, but we're really at the, let's see here. I am getting a comment from one of our esteemed attorneys to mention that the units can vote to move reserves into operating if there are major shortfalls. These votes can be done electronically. So that's good to know. Thank you. I know the attorney here. We've got great attorneys on this call, and I've seen some great property managers here as well, and a lot of names that I've never seen before. So I'm really happy that we can educate you. So let me just, in closing, say to you that we're going to keep these webcasts going. I do want to keep a special thanks to Brickell Homes Association for allowing us to also include their members in this group as well. And I also want to say that stay tuned, because we are probably the only CPA firm in Florida that's providing annual financial summits in the condo and HOA area. Now, for those of you who are not with condos and HOAs in the general business community there, please go to the website and subscribe to in whatever industry you're in for the advisories that we put out. We also have condo advisories. If you have people on your board or owners, or people on boards of other associations, please go to our website, sign up for those advisories here. We really welcome your input. We want to be the firm in Florida that provides the most amount of information to all boards around the state. So I want to also just to take this to thank, by the way, on those financial summits, before I do the thanks, this will be the 4th annual financial summit. The original one was dealt with all the finances of an association, had to understand the financial statements and what decisions, how you make them. After that, we had one on fraud and cybersecurity, and we will probably repeat that down the road, because fraud is rampant. We have a huge part of our litigation department is investigating frauds at the condo and homeowner association area. And cybersecurity is a major. The third one, which we had this past year, was on sea level rise and the impact of sea level rise. And since we do practice on the eastern seaboard of the United States, you would be amazed to see how New York and Florida are right there with the sea level rise implications for community associations. And I do believe that we'll do this fall, which will probably, I don't know that we'll have it in person, we'll probably do it virtually. And it probably is going to be on the pandemic and the recession, how associations are dealing with that, and things that we've learned over the next 4 to 6 months there. So look forward to it. Please spread the word on that. So the more people we have on the list there, you can send questions to us earlier. I do want to say thanks to Carl Gadinsky, Tucker. I also want to say thanks to our fantastic media team at MBAF, Victoria Arambulis, Nicola Costa, Jennifer Valdez. And I want to thank you all for participating. If you need any more information, you have a link, or rather an email for Jennifer Valdez to send to get more information from us. You can also just send it to info@mbafcpa.com, and we're happy to help. Thank you, everyone. Please stay safe, and I wish the best for everyone. Thank you.